Hi, welcome to Let's Talk Bonds, the fortnightly podcast from Iron and Bonds. And in today's podcast, we have a return guest, Mr. Chirag Doshi, who is the CIO of Fixed Income for LGT Wealth. And in the last conversation we had with Chirag in this podcast, he gave us a very strong insights into how the investors are behaving in terms of their investments in fixed income. And those insights Chirag is going to bring to you in something that is very appealing to investors and others alike, largely because of the fact that we are in a situation where there are many issues that are going through in the market, positives and negatives. And with this, we believe that this particular uh, uh, security, which is government bonds, are looking more and more attractive. Welcome, Chirag, and thank you for coming in to the show.
Hi, Arjun. Thank you for having me on your show, and it's always a pleasure to interact with you and have insights shared as well as learn from you.
Thanks, Chirag. And just to give you a brief on government bonds, investors have normally been in the last three, four, since COVID, government bond yields have been very volatile because after COVID, all central banks cut rates and yields went down to very low levels. And suddenly, when economy started to look up and with central banks pumping in money, inflation started to rise. And central banks also changed their course and started to hike rates, and GSec yields have climbed up. Investors in the last 3 years have been very happy to invest in high yielding corporate bonds. And given that, we are come at a situation spreads in a environment where the spreads have come down between corporate bonds and government bonds, and also the fact that a lot of other headwinds are happening. I will let Chirag to take you through these headwinds and also the positives and get us insights into this.
Sure. Sure. Thanks, Arjun. As you rightly mentioned, that the journey for the government bonds has been pretty much volatile in the past few years. In fact, it was not the same when the global financial crisis started. And since then, the only habit that investors globally or across the world has was to see rates only going lower and central banks only cutting and pumping huge amount of liquidity. And that continued till COVID. But post that, since a large amount of liquidity was floating around in the global markets and the central bank's balance sheets full, inflation became an inherent problem, right? And still it is. It has not come down to levels where central banks want them to be. And hence, in the past 2 years, we saw that the central banks hiked rate aggressively, though it was more pronounced in the developed world, where we saw the US Federal Reserve hike rates by around 550 basis points and also suck out liquidity via the quantitative tightening that they are pursuing. And also in India, we saw that the RBI hike rates and also absorbing liquidity from the system so that the rates remain at the policy signaling rate, that is the repo rate, and there is transmission of the rates that RBI wants where it wants it to keep in the overall economy. And inflation, of course, has come under control now, and hence the view now is that because of the growth suffering, we have seen that the global markets or the global world has not yet been. Of course, the growth is there, but it is not as what the central banks want them to be or government wants them to be for further job creation. But inflation, though it has settled down from multi-decade high levels, it is still a little bit higher. But having said that, the yield curves are inverted, where we are seeing that the 2-year, 3-year bonds are higher than where the 10-year or the 30-year bonds are being traded, which is a clear recession signal. And generally, what we have seen is that whenever the yield curve inverts, the central banks in the next 2 or 3 quarters, they also follow up with cutting rates, and that's what we are expecting. That in the second half of this year, or maybe by April June, the Federal Reserve will start cutting rates, and hence RBI will also follow suit, and hence there is a lot of capital gains that are going to be made in this year by investing into sovereign government bonds, as well as the interest rate instruments. So hence it's important to allocate portfolios or invest money incrementally into duration, increase the duration of the portfolio, and the best way to do it is through government bonds, in my view.
Okay. Yeah, inflation, the core inflation in India came in at 3.89% for December, and this has been the lowest in a while. And it's a very clear signal that for the RBI that their policies have been working, and they can afford to be a little more lenient in the next few months on rates itself. Uh, Having said that, on the capital gains fronts, basically for investors and who who want to understand how this markets work, when government bond yields go down, that is when interest rates go down, prices of government bonds go up. So when investors make money from buying at lower price and selling at higher price, that's as in capital gains. And there is an added benefit for bonds. After 1 year, if they make capital gains, they pay only 10% tax, as it is a long-term capital gains tax, which is what it is for government bonds. Given this, now LGT and Chirag has actually looking to create a small case for G-Secs. Chirag, could you take us through this small case?
Yes. So basically, a small case is nothing but a diversified portfolio of government bonds. So it's not holding one bond, but at least three bonds, uh, which is all our government bonds, and having different duration or different maturity that are there. And this can be basically bought at one go, where you have diversified portfolio, say maybe 35% into each. And the benchmark, generally the benchmark securities would be selected here. And when you invest, you basically invest into three securities which are coupon generating or interest generating. And whenever the yields go down, we will see that the price in all these securities move up, and hence, as Arjun explained, the capital gains can be made out of these bonds. And likewise, whenever the view changes, all the three securities, or the entire case, the small case, can be sold in the market, and the consideration received.
Chirag, the investors do they need to open a new account in anywhere, or can they just, if they have a demat, they can just invest? All they need to do is go through a platform and then invest.
Right. Yeah. So I think that's a very important point, Arjun. I think you don't need to do anything if you have an account, a wealth account, and a demat account in place, which is active. You don't need to do anything else. You just need to buy these bonds from INR bond platform. They will be credited in your account once the settlement is done. Once, of course, the money is remitted for settlement, and the bonds are then credited to your demat account, post which the coupons or the interest also starts flowing into the bank account in which the demat account has been mapped to.
Right. And all transactions for the GSECs in demand go through the stock exchanges through the platform of theirs, RFQ. So there is no settlement risk or counterparty risk in all this, and investors get the best benefit of easiest of transaction. Chirag, can you just confirm that if they invest in a portfolio, they don't have any expense ratios, they don't have any other costs, right?
Right. Yeah. There is no cost associated to it. There are no expenses, unlike a mutual fund where you invest into a mutual fund portfolio of similar bonds. There is an expense that you basically is adjusted in the NAV. Over here, the bonds are selected and curated for the interest rate movements that the portfolio is positioned to benefit from, and with zero expense.
Right. And the portfolio doesn't change, right? Without their consent.
Yes, yes, that's absolutely
Okay,
right.
sure. And also interest on government bonds has no TDS to that, right, Chirag?
Correct, correct. Yes. So, according to the finance bill, the interest on government bonds would not be subject to TDS. It is at the investor's hand, and of course, up to a certain amount, they are also not taxable. So, but of course, it doesn't matter. But over here, the ease of or the operational aspects are not there. Where in a corporate bond or any other listed instrument, there is also an aspect of TDS which the investor has to deal with.
And government bonds is the most liquid of all securities in the country. You can sell a government bond on a T+1 basis at any point of time whenever you require cash. Also, it is the most if you want to take a loan against your government bonds, any bank will give you a loan against the government bond holding. And those of you who actually trade in equities using margins, GSECs as a government bonds are a very good collateral for margins as well. So a lot of benefits of owning government bonds, apart from the fact that it carries no credit risk and no
Right.
liquidity risk. The only thing that it carries is interest rate risk. Chira, coming back to why GSECs, now, do you agree that India is in a good sweet spot at this point of time?
Yes, absolutely. I think with the growth, what RBI is currently projecting at 7% and inflation closer to their target rate, I think it's something which any central bank dreams of, and currently that's what happening in India. And with also the forex reserves that we have are quite comfortable. So from the external sector side also, we are not that vulnerable as we were 10 years back. So I think it's India is in a cusp of the both the equity markets and fixed income markets are at a cusp of gaining or making capital gains. And I think at this point in time, interest rates, the risk reward offered by interest rate instruments is higher than what you would see in any other asset class.
Sure. And with good, strong tax collections, the government is confident of reducing fiscal deficit, isn't it?
Yes, the expectations this year is that the fiscal number will be better than what it was last year, and of course, the gross borrowings, even if they remain the same, with the supply demand dynamics changing, with the JP Morgan bond inclusion, which will basically mean that there will be flows from the foreign entities into India, whoever is tracking that index, which could be to the tune of 25 to $30 billion, which means that there is going to be more demand for government bonds than supply. Also, RBI may not be doing OMO sales because liquidity is currently tight. They may not require to do it, and hence the supply demand will always remain in the favor of supply, where there will be lower supply than what currently the demand is estimated at.
Which is actually very good for country, because over the years we have seen that it's a very steady balance between supply and demand, and many times RBI has actually come in and uh, um, uh, create the shortfall in demand, then by buying bonds onto their own books, which they are not doing now.
Right.
So the prices, as such, are market determined, not artificially determined by RBI, which is a very positive sign. And investors are getting the right level uh, of government bonds because of the fact that the prices are determined by the demand supply in the market and not by a single force that is actually swaying the demand supply.
True.
The other thing is that, on the index front, yes, the good demand, and with Bloomberg being included, then there could be other uh, index trackers as well, including Indian government bonds. So all this put together looks to be a good story. But what could be the biggest risks in this, Chirag?
The biggest risk is that even though, say, the global central banks do cut, RBI refrains from doing so uh, because the risk spread between India and US, I think it's at its lowest since what we have seen. Inflation also remains one of the largest risks. So if you see that the crude oil prices are going up from here or settling around, say, 90 or 100, then that could also be a risk. And of course, the it's an election year, so if there are some fiscal rollouts by the government, which could disturb the fiscal balance, that could also lead to a rise in the yields. But the probability of all such scenarios are much lower. I think on that front, we are on the tailwind side, where government is very much aware about the softer aspects, and hopefully they should not, be doing that. And inflation, as we discussed, is well under control. We don't see it going higher from here. In fact, RBI's projection for this year is at 4.5, which means that RBI will not be very much keen to sway or hike rates from here, as they will not require to do so.
Sure. I think so. Given that, I think your portfolio basket at this point of time, or what is it called, a G-Sec small case, is an ideal investment opportunity for investors, brought to you by a very studied analysis by the LGT team led by Chirag, and also given that government bonds with has they don't have any kind of a risk associated with government bonds in terms of credit risk or in liquidity risk. So even if prices fall, investors who hold it to maturity will not lose any money. Government will always pay back your money at any point of time. So there's no worry on that. So
Yeah.
Chirag, any parting comments for your investors and for the on the GSec small case?
Yes, I think one very important aspect, or I would say an advantage in this GSec small case, is the lot size as well, right? Earlier, when you, of course, through a mutual fund, you could, invest in a diversified portfolio, but as we saw that it has expenses and you cannot choose, they can choose the security that you like. Over here, it is a curated portfolio, and it remains static, so you can enjoy the overall benefit of the interest rates coming down, and also at lot sizes what you would prefer to have. And with it also available in the demat mode earlier, where it was not. It had to be bought through mutual funds or any other such vehicles. With this online platforms and NR bonds, curating this and getting the liquidity, where the buy and sell is also quite easy because it's liquid at any given point in time, as Arjun explained. It makes perfect sense for investors at this point in time to lock in yields. We may not see such yields uh, maybe by the end of this year, because central banks will cut rates, and to make maximum gain out of the government bonds, and to also make capital gains, decent capital gains, where investors could make around 8 to 10% returns by just holding these bonds. I think this is the right time to go for it.
Yes, absolutely. And one very important factor to note for investors, especially those who have gone through the COVID scene, many of them have seen that deposit rates have come down so sharply to 4%, where uh, they couldn't earn anything from bank deposits. And so now GSEC's investing in a GSEC basket with a mix of long-term bonds protects them again from this sharp fall in deposit rates, which effectively protects them from reinvestment risk. So you might invest in deposits at higher rates, but when they mature, you might find that they could be at 4%. So this is a very important factor for investors, and many investors have actually, I think Chirag would agree on this, have been really worried about this kind of a because when at 4% and inflation at 6%, it's very difficult to keep pace with the expenses.
Right. I think even for the long-term investors like savers or retirees who would have a significant part of their savings invested in fixed deposits, and there is a reinvestment risk, right? Like you rightly mentioned, Doctor. Over here, if you buy a 15-year, 10-year, 15-year bond, and we all know that in the next decade, the yields may not remain where they are. You'll always see lower highs going forward. This becomes the best option where you have a fixed deposit like return paid every 6 months for the time that you want to select for yourself, and there is no credit risk, no default risk. So it's absolutely apt for someone who wants to invest for a longer period of time with having stable cash flows as well.
Yeah. Thank you, Chirag. And it was really great to hear your views and and hopefully now more and more investors will start to look at government bonds, which has been what RBI, the government, the regulator, SEBI, all of them are keen because of the fact that government bonds offers very low risk um, investment for investors, and also helps in the overall macroeconomic so that the economy itself grows, the government is able to maintain its budget deficit and keep interest rates down in the economy. All put together, investors are benefited by investing in government bonds, and now with a small case, they can invest in a diversified portfolio of bonds with very low ticket sizes as well. So you really don't need to have very large sums of money to invest in this basket. Thank you very much, Chirag, and
Thanks.
look
Thank you,
forward to
Arjun.
having
Thank you
you
for
more
having me.
on the show.